In 2015, the United Nations developed 17 Sustainable Development Goals, also known as the UN SDGs, as a universal call to action to end poverty, protect the planet, and ensure that by 2030, all people enjoy peace and prosperity. From an investment perspective, these 17 SDGs can be used as a framework for investors to apply sustainable thinking to their investment decision-making process and engagement practices. It's 2022 and we are now past the halfway point from the inception of the SDGs, and many are wondering whether we're on track to meet that 2030 goal or not. My name is Anu Rajakumar, and today I'm excited to bring back Chris Kocinski, co-head of US High Yield and a senior portfolio manager, and Sarah Peasey, director of European ESG Investing, to explore how these 17 goals can be integrated into an investment process and as a framework for company engagement. Chris, Sarah, thanks for returning to the show.
Thank you.
Thanks, Anu. Great to be back.
So let's start off with a high-level overview of what the United Nations Sustainable Development Goals are and explain what it means to have investment strategies that integrate these UN SDGs. Over to you, Sarah.
Great. Thanks, Anu. As you mentioned in your introduction, the UN SDGs were set back in 2015 now, and they were set by 193 of the UN member states. And the 17 goals are aimed at the likes of ending poverty, improving health, education, reducing inequality, and then focusing on climate change, preserving oceans and forests. But I often think that everyone, and rightly so, is quite fixated on 2050 as a timeline, given the global net zero goals aligned with the Paris Agreement. But the SDGs actually have a target of 2030. The concerning news is that prior to the global pandemic, the world was already off course to actually hit this 2030 milestone. And unfortunately, post-COVID, it's only exacerbated these problems further. And in certain cases, with some of the SDGs, we've actually gone back below the 2050 baselines in which they were set. And all these measurements are captured annually in a UN SDG report. The latest report, in fact, revealed some pretty shocking statistics, and there's a couple that I think are just worth sharing just to kind of drill it home. An additional 120 million people were pushed back into poverty in 2020, and the equivalent of 255 million full-time jobs were lost globally. And the number of people suffering from hunger, which was already climbing obviously prior to the pandemic, now they think may have increased in excess of 100 million. And actually probably one of the most shocking ones for me when I was reading was that around 68 vaccines were administered for every 100 people in Europe and North America. But if we compare that to sub-Saharan Africa, that was fewer than 2. So I wish I could say that there wasn't as many kind of shocking facts in this report, but there were even more when I was reading through it. And ultimately, that really prompted me, and it's prompted us before this point even, to really ask what are investors doing about this. And this is really where our thinking gets going, and how to integrate SDGs into funds objectives and actually work out how can we more positively contribute towards them. Now, I mentioned that the SDGs were established by UN states, but they weren't necessarily set up with investors like us in mind. However, given the absolute minefield out there of industry frameworks, ESG scores, the SDGs are actually good at providing this kind of universal framework or some kind of common ground between different stakeholders. And those stakeholders, most importantly, of course, still remain governments. But for us, it's that dialogue between corporates and investors. And at MB, we use the SDGs to structure and communicate objectives for our impact strategies. And the contribution to the UN SDGs for these strategies actually for us comes from not only investing, but also engaging with these companies and getting an understanding of the products, services that we think could actually positively contribute to some of these outcomes. But one of the asset classes that we've actually found that the SDGs can be particularly relevant and compatible for is non-investment grade credit or high yield.
All right, terrific. Thank you for that background. And obviously, it's a shame to hear that we are not really on track to meet that 2030 goal or, even the 2050 goal, given some of the challenges that we've experienced in the last few years. Maybe, Chris, turning to you. You're a portfolio manager responsible for constructing portfolios aligned with the UN SDGs. And as Sarah mentioned, these seem to be quite well aligned to non-investment grade or high yield portfolios. And I understand that you prioritize engagement as a tool within your investment process. So tell our listeners why you place an emphasis on engagement and also what the intended outcome is.
Well, I think starting from a high level, I think private markets are going to have an important role to play if we're going to continue to make progress around the world towards the SDGs. And the high yield market and non-investment grade markets in general are a great place to reach companies that may not traditionally be reached by public markets. The global high yield market is about 40% comprised of privately owned companies, and many of the others tend to have a smaller market cap and might not be a focus for public equity funds. And so what we found is that when you have a real relationship with company management teams, that they're seeking guidance on how to approach these topics. And it's very helpful to provide them with a common framework to align their business objectives around, such as the SDGs. And we're having a good amount of success engaging with management teams on those topics. I think that when we look at what is the key driver of success, if you're going to establish an engagement platform, it really centers around the depth of your management relationships. And that's critical to underwriting credit and producing attractive financial returns for investors. But it's also critical to driving a successful engagement program over time. And we've decided to structure our engagement approach where our investment team, our research analysts are leading the engagement activity because they have a relationship with senior management team, given the scale of our platform. And they get advice and oversight and guidance from ESG experts that are part of our ESG investing team. But our research analysts are the ones reaching out to the CFO of a company and having a dialogue that's comprehensive, discussing balance sheet issues, industry issues, and also specific ESG topics. Very important to pair the access to management with a systematic process, in our view. Our team generally is very process oriented in how we invest and underwrite credit, and our approach to engagement is no different. We judge the likelihood of engagement upfront before we invest in an issuer. We then have a specific engagement objective that we set for each of the issuers. And it's an iterative process between research analysts and the ESG investing team to set those objectives. And importantly, to set the KPIs that we'll use to judge how progress is moving along over time for each of those goals. I think the key principle that we've used in organizing these activities in non-investment grade credit is that we understand that asset owners need income in their portfolios, and many of them don't have the ability to sacrifice income, but at the same time, they need to move forward on sustainable objectives of their own. And we think that we've been able to pair an attractive level of income and a robust engagement framework together into the way that we've structured the platform. And if you think about, if asset owners really want to make a difference in terms of moving towards the SDGs, we're probably not going to have a situation where 1 or 2 or 3% of funds are formally incorporating these objectives, and that share of the pie is likely going to have to grow over time.
Yeah, absolutely. And I think to your point that you need to have those impactful and thoughtful engagements in order to do that. Chris, I want to just pick up on something that you mentioned. You said that the ESG investing team at Neuberger helps to set up a framework to judge the progress and kind of monitor those metrics for those companies. So maybe if I turn it over to Sarah on that point, how do you set engagement goals aligned to UN SDGs? And if one of you doesn't mind, maybe you can walk us through an example of a recent engagement with a company.
Yeah, so I think really important to kind of stress, and this point that you've made, is the collaboration between the high yield research team and the ESG investing team. Our starting point is obviously to assess the opportunity from a company management perspective to actually establish the objectives and where do we actually think the opportunities lie. And we can look at these from different angles, and sometimes we might draw upon what we consider to be mega trends happening in the wider economic environment, or whether it's actually more industry specific initiatives, but where can we then draw upon some clear mapping with the SDGs, which aligns to companies that are in our direct investable universe? And I know it probably sounds obvious, but one of the most important points for us is to properly focus on, when we're setting an SDG linked goal, is it actually relevant to the business model? And by that, I mean the business's products and services. And we're looking for a real kind of natural fit when we're actually applying this goal. Because for us, it's about trying to deliver the most impact or incremental change, because these objectives that we're setting should not just be ceremonial in some kind of way. And also, as Chris probably has heard too many times from me, they shouldn't be easy either. We should really be trying to test these companies and their ability to properly deliver change, because as I stated up front, we are behind, and these are some really lofty goals that are intended behind this framework. But in parallel with all of this, one very important point to us as well is assessing the likelihood of engagement success. So before we've even embarked on engaging with any of these companies, we've really got to call upon this strength in relationship with management, as Chris has already alluded to, and judge the willingness for these companies to actually engage on these topics. And from a business model perspective, does their balance sheet look healthy enough to adapt and to actually change in line with some of these objectives that we're setting them? So all of this happens before we've even got down to the point of crucially selecting the key performance indicator, or the KPI, which is crucial to us, obviously, then measuring ongoing success and progress at the company level. So if I was to summarize every engagement objective and its related KPI, we think of it as kind of a combination of top-down SDG goals, but also maybe issuer or industry-specific opportunities, and also this assessment for potential engagement. We have actually just released our Global High Yield SDG engagement report, and I'd love to encourage all of our listeners to have a read, and it includes engagement statistics for the quarter, but also some direct case studies as well, which show this distribution of objectives mapped to the SDGs.
Yeah, I mean, if I can just take you inside of a typical scenario where we're talking with the management team, the dialogue would be taking place between a senior research analyst on the non-investment grade team and the CFO of the issuer that we're investing in. And most likely we're one of the larger bondholders in the company's capital structure, and on average likely have been invested for somewhere between 2 and 4 years in the business. And the dialogue between those two would encompass a broad range of topics, from financial and industry topics to ESG topics, and then importantly, a specific engagement objective that we communicate to the management team and indicate to them that we're going to track progress on that over time. So the key point being that this is a relationship. This isn't a one-time interaction. This is most frequently a years-long relationship where ESG goals are one of the things that we're talking to management teams about. We find that to be a very successful way to access senior management teams. And about half of our engagements on the SDG topics that we set in these portfolios are with the CFO level or higher in the companies that we invest in, which is a statistic that we're particularly proud of. In terms of bringing to life what an engagement objective would be, we are invested in an LNG export business as a recent example, and they have said publicly that they would like to achieve net zero before 2050. But in this instance, the company hasn't set any tangible ways through metrics or otherwise for how the market could judge their progress. It's just a vague commitment. Our engagement objective for them is to be more specific, right? Align their activities with a certain framework, make information available to the public to prove out their progress over time. And we think that's important to lend credibility to the objective that they've put out there in the public. So that's one recent example.
All right, perfect. Thank you very much. Just going on from that example where you're asking the company to just be really specific, and then I assume, kind of following up with them and measuring their progress. Sarah, you said earlier on that you really are trying to challenge these companies to do better and to seek these positive outcomes. One big pushback that investors often highlight or are concerned about is whether doing all of this sacrifices company, shareholder value. What do you have to say about that? Do you think that there is a potential hit to portfolio yield as you pursue these UN SDGs with these companies?
Yeah, the simple answer is no. And we've designed our approach, following many dialogues with our asset owner clients around the world. And we understand that they need income in their portfolios. And as I mentioned earlier, many of them don't have the ability to sacrifice income, but they still need to move forward on sustainable objectives. And when you think about an engagement-centric portfolio, the investable universe is still broadly available to the portfolio management team. And you're not investing in companies that aren't willing to engage with you. But in today's world, that's pretty rare, to be honest. And you're not taking a heavy exclusionary approach. You're prioritizing helping to drive progress as opposed to divesting from a variety of different industries. And by taking that approach, you can continue to generate competitive total returns and yield for asset owners. And at the same time, you're invested in businesses. That means you have a dialogue and you can hopefully help them improve over time. And so if you're authentic in how you're approaching the engagement and you're truly helping to move the needle over time, I think that we can successfully achieve both income generation and progress on engagement objectives for our clients.
Terrific. That was very well said. And again, just a reminder that the reason why we do these engagements is because they are thoughtful, they're thorough, they're impactful. Now, in the volatile climate that we live in, I'm curious, how has the dialogue with these companies shifted in the last 12 months? And have there been any changes in the tone or the focus that you've been seeing as you engage with company management?
First of all, of course, conversations have changed. We've all seen the very severe global economic fallout from the horrendous war in Ukraine, and the biggest of which has obviously been a surge in energy prices. And in an extreme kind of macro situation such as this, the conversations that we have with companies requires a degree of pragmatism. And for this particular situation, it's a case of acknowledging that carbon emissions are simply just not the only evil in the world. And we are living in extraordinary times, and especially with energy markets. So being able to leverage those strong relationships with management that we've built up over the years, that is what's especially valuable when markets do become more volatile. And of course, there are instances where goals have to be deprioritized and to focus more on the short-term business issues around operations and finances. But having these strong relationships in place means that we can still hopefully influence over time and ensure that when things do stabilise from a market standpoint, we can get them reprioritised. Look, fundamentally, we do still see lots of momentum in the corporate world, particularly with issues around climate change. And this is all in spite of pretty severe ongoing challenges tied to pandemic recovery, but obviously now inflation and the geopolitical conflict that I've already mentioned. And look, I appreciate we're talking about fixed income today, but we're just obviously wrapping up the proxy voting season as well. And I think it's important to highlight that during this period, we saw a number of board recommendations proposing net zero strategies, but also more tangible targets towards reductions in GHG emissions. And up until this point, it's been very rare, especially from US companies, to see these kinds of proposals. So my point being that there are challenges and conversations are different, but the challenges aren't going away or even slowing down. So we still have to add this degree of pragmatism, as I said, in the way that we're approaching it. But Chris, you're on the ground. So I'll hand over to you for more colour.
Well, I think importantly, the first takeaway is that the SDGs represent, in many ways, mega trends that are happening in the global economy. And those are moving forward sort of regardless of whether you're in a volatile environment or not. And I think companies understand that. And as a result, there's momentum towards trying to make progress on these topics that isn't necessarily exposed to what's going on in the broader economy at any given point in time. And I say that that's broadly true, probably for 80 or 90% of the companies. And of course, if you have an issuer that gets into a deeply distressed balance sheet situation or something like that, that may be different. But broadly, there continues to be a lot of dialogue. I think increasingly what I've been seeing over the last year is management teams want more specific guidance. And a common instance would be a CFO coming to us saying, everyone is coming to me asking me for something. No one is specific. What do you guys recommend? And those are terrific conversations to be having with management teams. So they appreciate specific dialogue because ultimately in their business, they need to get down to how are they going to change operations over time, et cetera. So providing a common framework such as the SDGs to organize their activities around, very helpful to them. And the more specific, the better. One trend we've noticed in the last 12 to 18 months really is more companies are bringing on ESG specific staff into their senior management teams. And we've seen probably about a 10% shift over the past 18 months in dialogue from CFO to senior ESG officer or something akin to that title. We view that as probably a neutral effect because it shows a commitment from companies to make progress on these topics at the senior level of management.
All right, terrific. It sounds like when you speak to companies, they're asking for specific guidance. What do you recommend? But I also just want to, pick up on something Sarah said, that you have to approach some of these with pragmatism. What happens when an engagement is not successful, right? So you're giving them all these recommendations, you're sharing the guidance, you want to see them succeed and align with these specific goals, but sometimes that's just not feasible. What happens then?
Well, I think most importantly, if you think about what we're driving towards here, it's trying to remain invested in issuers, have a dialogue with senior management and help them improve their business alignment with the SDGs over time. And so from that perspective, divesting from a company is not an ideal circumstance, and we try to avoid it. The method that we use in doing so is we try to take several different angles to get a dialogue going when we're in this situation. First would be our senior research analysts would elevate the dialogue and make it clear that it was very important to us that we have discussions on topics related to our engagement objective. If that was unsuccessful, our PM team would likely try to reach out to the senior management team, potentially in conjunction with a member of our ESG investing team. And also, we use high yield conferences or other venues as methods to try to get a dialogue going with company management teams. We do screen for the likelihood of a company engaging with us before we invest. So the situation I'm describing is not very common, but it has happened. And we think that a 2 to 3 year time frame is a reasonable one for judging whether a management team is willing to have a legitimate dialogue with us on these topics.
All right. Thank you very much, Chris. Now, as we come to a conclusion, would like for both of you to briefly summarize some of your key takeaways from this discussion.
I think that if progress towards the SDGs is going to be accelerated, I think the share of the pie in terms of capital devoted to investments and funds that are specifically incorporating the SDGs is going to need to grow. And we've approached that with the dual objective of generating income and total returns that are competitive with traditional strategies, and then also having a very robust engagement framework centered around the SDGs. And by doing so, we think that we're having authentic dialogue with company management teams, and that leads to rich, important case studies. And we hope to continue to produce those over time for the investors in our funds.
So firstly, the SDGs actually act as a universal framework, so a common language or common ground between companies and investors, which we've never really had before. So it's incredibly helpful when engaging and obviously setting objectives. But as a society, we can't shy away from the fact we are significantly off track, and we need to do more to make progress towards that 2030 deadline. And this is exactly why capital markets are and will continue to play such a fundamental role in deploying this capital. I think universally, all stakeholders believe that more meaningful data on, like whether it's social or environmental impact of funds, could be absolutely transformational for the investment industry. And through the integration of the UN SDGs, investors are actually able to measure this positive contribution coming from these investments, which is why we stand behind it and its integration into a number of our sustainable and impact strategies. I think people are largely comfortable with how you engage on the equity side because of voting rights, but I think it's very important to us on the fixed income side to really challenge that notion that engagement through debt can be very effective, and it doesn't necessarily just has to be focused around an issuance cycle. That the fixed income investor has a far bigger voice around the table than it's ever had before, and this is because of some of these really pressing global challenges that we've discussed today. And companies will need to draw upon their capital to make progress towards them, and this couldn't be more relevant for the asset class of high yield.
Excellent. That's a great place to end on, Sarah. Thank you very much. Before I let you go, we do have a quick bonus question. Today, we focused our discussion on the UN SDGs. So I would love to hear from both of you, which of the 17 SDGs resonates most closely with you and why? And while you think about that, in case our listeners are not familiar, I'm going to quickly rattle off those 17 goals, which are no poverty, zero hunger, good health and well-being, quality education, gender equality, clean water and sanitation, affordable and clean energy, decent work and economic growth, industry, innovation and infrastructure, reduced inequalities, sustainable cities and communities, responsible consumption and production, climate action, life below water, life on land, peace, justice and strong institutions, and number C, partnership for the goals. So Chris, over to you first.
Affordable and clean energy would be for me. And I think both of those terms are important. And I think we're seeing that in the current environment that, if you take a true engagement and transition focused approach, that's probably the best approach to this on a global basis. And that being part of those discussions, I find to be personally enriching for me.
Lovely. Thank you very much, Chris. And Sarah?
So I'm going to go number 13, climate action. If anybody knows me well enough, they know how dear climate is to my heart. And I actually think in progressing with some of these climate challenges, we can make simultaneous progress with a number of the other SDGs as well. So that for me is a really kind of crucial one to unlock, to be able to actually make progression with all other 16 of the SDGs.
Well, thank you very much. That's an excellent note to end on. Chris, Sarah, it's been great having you back on the show to discuss how these SDGs truly are advancing the investment and engagement process. Really appreciate hearing a few examples of how they work within your engagement with companies and how these goals can really create a plan of action for people, the planet, and its prosperity. Thank you again, both, for joining me.
Thank you.
Thanks, Anu. Thanks, Chris.
And to our listeners, if you've liked what you've heard today on Disruptive Forces, you can subscribe to the show via Apple Podcasts, Google Podcasts, or Spotify, or you can visit our website, www.nb.com/Disruptive Forces, for previous episodes, as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.